hoping to get one speaker up, Martin. In the meantime, we'll have Nicholas start us off.
To our unusual Whales FOMC panel of macroeconomic experts. This meeting comes with a more complicated backdrop, I'd say, than the market was dealing with even a couple weeks ago, let alone way back at our last FOMC panel. Inflation, at least in the last CPI report, didn't re-accelerate, but growth itself has kind of lost momentum. February payrolls turned negative, for example. Unemployment moved higher with revisions all over the place between that and the labor market. And oil has surged on a fresh geopolitical shock. As you've all seen, hopefully things blow over soon, because that kind of thing is never good for the planet or the people that inhabit it. At the same time, markets have had to kind of rethink the rate path almost in real time as cuts get pushed further out, and central banks globally have started sounding more cautious again. So the question today is not really whether the Fed moves, it's more or less kind of how they choose to frame the trade-off that's in front of them now. Softer labor data, still above target inflation, and a new energy shock kind of sitting on top of both of those things. Now, as always, while we still try to get our speakers up, I'm going to run through my normal introductions of each panelist today, starting off, of course, with Joseph Wang, better known to most of you as the Fed guy. He previously ran trading on the Fed's open markets desk. He literally worked right inside of the machine that we're all monitoring and making a live off of today. And now he's the CIO of Monetary Macro. I always plug this upcoming book here in a second on every single panel because it's a pretty cool one. I learned a lot from it myself. He's the author of Central Banking 101, and it somehow managed to make the Fed understandable. Joseph, always great to have you here, man. How you doing today? Not sure if it's just me, but I didn't hear anything. So, Whale, if you're in the chat as well, let me know if my Twitter's broken or if we lost the Joseph. And then he dropped. Hey, Martin, if you could, real quick, before I read your elegant intro, could you just say something quick to see if I'm hearing anything on my side?
Testing. 1, 2, 3.
All right, perfect. Good. I was just making sure. We've been Twitter was down for like an hour earlier. I'm just making sure things are working for most. And that said, the homie that just spoke up there is my man, Martin Peltier, portfolio manager at Trivest Wealth Council, a regular contributor to the Financial Post, a regular contributor to Unusual Whales, and he's the only one who can talk all day about macro and then go do flips and shit on the slopes. How you doing, Marco? Welcome back.
Yeah, awesome. Thanks for having me. Hopefully I try and keep the flips to a single today. But I posted my son. He did a triple and crash landed. So lessons learned from being a senior.
And here I am pulling my back, just getting out of bed every morning. Props to you and the kid. Up next, we've got my man Marko Bjekovic, the founder and CEO of Archimeda Research, providing in-depth research on U.S. macroeconomics and the markets as a whole. Marko has nearly 2 decades of experience working in the markets as an equity broker, investment advisor, manager, you name it. His forecasts and analysis help educate and inform investors pretty much all over the planet from what I've seen, and we're glad to have him joining us today. As always, welcome back, Marko.
Thank you very much. It's great to be here again.
All right, I'm just going to go ahead and jump into this. So kind of just taking a quick peek at monetary policy and kind of the rate path. Heading into today's decision, the market is pretty broadly expecting a hold. I don't think we're seeing any real arguments there, but the more interesting story to me is kind of how quickly that expected path has shifted. If you recall, not all that long ago, the conversation was still centered on when cuts would begin. And now after the latest labor data, the geopolitical stuff going on, the move in oil, markets seem to have become a little less confident in the idea of multiple cuts this year. So rates, again, expected to stay the same today, completely unchanged, but with CPI still above target, core PCE still running hotter than the latest CPI would suggest. I guess my question is, from the Fed's point of view here, Are they kind of in a position where holding steady still feels like a neutral move that's kind of getting more restrictive in practice, or how are we feeling here? Let's start with Martin here, and I'll keep trying to get Joseph back.
That's a good question. I mean, they've really been throwing a wrench over the last month here. Iran is a very, very serious situation. I've spent the first 10 years of the initial 10 years of my career in the oil market as an oil and gas analyst. And I was fortunate enough to fly out to Vienna last year and meet with OPEC directly. The situation is very similar to what we saw in the 1990 Gulf War or the 2007-08 oil shock. And I think that's important context to as to what the Fed is going to position themselves, because you've got the numbers came out today with the PPI. The U.S. dollar is actually up with oil prices. It's up 4% since its January lows, which is not unusual during oil shocks.
And real quick, like I hate to interrupt, but can you harp on that a little bit and kind of explain that relationship? Because I do notice, and it might be completely unrelated, I do notice that equities tend to inverse the big oil moves. How does that work with the U.S. dollar?
Well, yeah, no, it just when it's longer term, so it has to get set in. So typically, what will happen is if the price gets entrenched, and this turns into a longer term situation with higher oil prices, then more so from a demand side, rather than a supply disruption like what we saw in the 2000s, then the dollar will retreat back and sell off as oil moves higher, and long duration equities will continue to not perform very well in that environment. In today's situation, you have a really steep curve in regards to backwardation. So that means that the spot price is really high in regards to the forward price. And that's telling you there isn't belief that this is going to be sustainable. And it's also coming at a time when the global economy is in somewhat of a flat to maybe even on the verge of a recession. And so that's going to be playing out in regards to long duration equities. So what we see now and how the Fed responds in today's environment is going to be very, very important as to how it influences equities, how it influences the broader economy. And that's why you have to factor that into their decision, more so than any other time. And then where's that dollar going to end up? Because, for example, gold has been selling off with the rise in the U.S. dollar. But if you look at previous oil shocks that are similar to today's situation, the Fed has eased despite the shocks. And I think that's what we need to see, rather than holding pat. But we'll have to see what they do.
Thank you, Martin. A lot to digest there, and we're going to revisit a lot of the points you just made. But first, I mean, obviously, especially since the last panel, a lot's changed pretty fast, because there was even a line making the rounds this past week or two that the next move from the Fed could end up being a hike rather than a cut. And so is that even a real risk worth taking seriously, or is it more kind of a reflection of how quickly that oil shock might have scrambled the discussion? Joseph, hop on there, see if we can get a quick mic check, and if so, I'll have you tackle this one.
Hello, can you hear me?
Yes, beautiful, perfect.
Perfect. Well, first off, thanks so much for inviting me. I appreciate it. Great to be on the panel again. And so I caught part of Martin's discussion. I'm going to defer to Martin on all things oil. It's definitely a huge shock. Now, when it comes to the Fed, when I look at market pricing, it looks like the higher oil prices go, the more hawkish rate path is being priced in. So right now we're only pricing in one cut this year, and in the Eurozone, we're actually pricing in cuts. So the market is definitely perceiving that higher oil prices is going to lead to a more hawkish Fed. And like you noted, Nick, there's also one Fed president who actually is saying that maybe the Fed should hike rates. That's definitely not going to happen. Okay, there's no way that's going to happen.
Break that down for us, because I love a good confident set it with his chest statement.
So, like Martin mentioned, historically speaking, when we have these oil shocks, the Fed doesn't hike. So, according to standard central banking dogma, which is what everyone learns when they go to central banking school, is that when you have these negative supply shocks, you look through them, which is also what the Bank of Canada did today. The reason you look through these supply shocks is twofold, really. One is that monetary policy, according to the received wisdom, acts on a lag. And so let's say that you do something with interest rates today, it'll probably impact the economy, let's say 12 months from now. And by that time, who knows what happens with these geopolitical shocks, right? So you really can't, there's a mismatch in timing. The second is that these supply shocks are more of a one-time increase in the price level rather than, say, a change in the inflation dynamics. So we heard a lot about that during the tariffs, right? So Trump put tariffs on, let's say everything, the price of everything goes up a little bit. But next year, I don't think anyone expects tariffs to go even higher, right? So it's going to be a one-time increase in the level of prices rather than a change in the rate of change, that is to say inflation. And so that's another reason why a central bank wouldn't react to this. Now, we actually have pretty good historical examples as well. So in 2003, there was the Iraq invasion. At that time, the economy was pretty weak. We were right after the dot-com bust. And at that time, oil prices were also surging because everyone was anticipating an invasion into Iraq would be destabilizing. And so they were pricing that in. The Fed actually looked through that and continued to cut. And they were correct because the military aspect of the Iraq invasion was actually over very quickly, and the oil prices imploded totally in a very short amount of time. So that inflation concern that was gone. The same thing happened in the 1990s. There was something called Operation Desert Storm, where Iraq had invaded its neighbor Kuwait, and the U.S. assembled a coalition to go and protect Kuwait. So at that time, you also had a tremendous surge in oil prices. The Fed also looked through that, and that was the right choice because the hostilities ended pretty quickly, and oil prices totally imploded. I think one day 30% drop once the hostilities commenced because everyone perceived that it would be over soon. So this is the standard central banking playbook, is to look through that. And so I think that's going to carry weight here as well. I would actually expect we have a few dissents today because unlike other central banks, the US is actually a two-mandate central bank, got full employment and price stability. So for other central banks, you can maybe make an argument saying that oil prices are going up. We don't know how long this is going to last, so we got to react to this. But for the US, you have to moderate that with the weakening labor market. Last month, we got a jobs report that was surprisingly bad. So I think that the path from my perspective is that we're going to get more cuts, probably a lot more cuts than the market anticipates. They're probably going to be more aggressive once we have more clarity on the geopolitical situation. That's also what happened in 2003 as well.
I'd like to jump in, Joseph.
Please do, yeah.
Yeah. What about if gasoline prices are up 25% across the board? I know the U.S. consumer is not as sensitive as it used to be, but gasoline still has a meaningful impact on the consumer spending. You have to think that that the huge spike in gasoline, albeit temporary, is akin to tightening and raising rates. I mean, it has to have an impact on the consumer, and it could accelerate the wage growth, lack of wage growth, and unemployment. I'm just throwing that out there.
Yeah, that's definitely true. It has a contractionary impact, right? So we're looking at, from my perspective, we're looking at a global recession right now. So one way to think about this is a recession is just producing fewer goods and services this year compared to the last year. That's negative growth. One way you have fewer outputs is because you have fewer inputs, right? We have a huge negative oil shock, so we're heading into recession. It's probably going to be global, and that's going to impact U.S. consumers and spending. And looking at the stock market, it looks like we've been trending lower. We're losing a lot of momentum. So I do think the contractionary impacts of this are going to be more impactful than the inflationary impacts. And that's part of the reason why I think we're going to get more cuts than the market expects. And one other thing to note is that, in these situations, somewhat stagflationary, there is some degree of maneuver for every Fed official because you can point and choose the different things to focus on. So in these contexts, I think who sits on the FOMC is very important in the sense the FOMC becomes a little bit like the US Supreme Court, where people are like, this is a liberal justice, it's a conservative justice, and so forth. We're having a change in the composition of the FOMC, and so we're going to have a new Fed chair, and who knows, maybe Chair Powell steps down, and we get a new governor as well. So I'm gonna guess that President Trump is going to be choosing people who are more dovish, and so we're going to focus more on that growth aspect, that employment impact than inflation. And so they certainly have enough cover to do that. So I think I do think that growth and inflation are going to be more dominant going forward as something to emphasize on.
Thank you both. And so, just kind of one more thing here before I move on to kind of general financial conditions. There's also, and Joseph touched on it a little bit there, but there's also kind of a theoretical version of today where the Fed tries to tighten the message without necessarily tightening policy itself. And so I wonder, Marco, do you think that that's a likely outcome here where Powell leans tougher through the dots in the press conference, but without actually changing in practice the current stance?
That's definitely a possibility. Sure. Actually, when you hear what other Fed chairs have said, like Bernanke, for example, Ben Bernanke, it's more like the Fed is using this speech or the tone, or it's more important for them what they say than what they do. Like it's more like I think that Bernanke said something like, okay, it's 98% of 98% of their job is speech, and only 2% is like what they actually do, like actions. So this is actually what they might do today. If Powell strikes a bit more hawkish tone, this could have this could have a more restrictive impact that could lead to what they actually want to achieve here. Because I actually agree with what Joseph said. There is no way that they are going to hike like it's this is like they just don't have much reason to do that, especially when the labor market is as weak as it is. They've seen. I think that they are actually going to focus on the labor market and not focus that much on the geopolitical stuff, because the geopolitical stuff is something that they cannot control. Like it's a given. They will just these shocks will be here or they will not be here. But if they see more weakening in the labor market, they could actually do something about it, and they could potentially contemplate a cut at some point going forward. This could, I'm probably an outlier here, but I think that there is also a possibility that they cut as soon as April, if, for example, the employment report for March shows weakening to the same degree that, for example, February showed, because they had like January was stronger and February was weaker, and then if March again is weak, maybe there is a way or there's a path for them to cut in April. This is something that the market is not pricing in at this moment, but it could potentially become a viable scenario if the labor market weakens. So this is something I think that we need to focus on, because they are really like sensitive to what happens to the labor market. If on the other hand job growth picks up, then they could probably become more hawkish. For example, they could use a more hawkish rhetoric to try and I don't know, maybe say, okay, maybe we are close to neutral or whatever, and maybe we are going to pause for I don't know how long. But if the labor market starts weakening in a true sense, they are actually going to respond.
Thank you, Marco. So kind of just he mentioned that market's not quite pricing in quite yet. I want to harp a little bit here on financial conditions and just market signals as a whole, for lack of a better word. So I would argue that they're not really giving one singular clear signal right now. Bond yields have kind of stayed elevated. Oil's obviously up sharply as hell this month. Mortgage rates kind of backed up a little bit, and stocks, I mean, they're down-ish, but for the most part, they're kind of still holding it together better than I would say a lot of people have expected going into today's meeting. So, in this kind of scenario, with equities still hanging in there despite higher oil, there's fewer expected cuts than this time even a month ago, and sticky long yields. Does that tell us that financial conditions maybe still aren't restrictive enough, or is it just an indication that the market's waiting on Powell before making a bigger move? Joseph?
Well, I think part of the reason that the market has been holding up, and this is a time where we really miss Jim Carson, because this is what he's been talking about over the past 2 weeks, is that Jim has been noted repeatedly that there seems to be a lot of gamma in the market that is keeping the stock market supported through options expiry this week. And so maybe that's the reason why, even after we have all this really bad news, that the market seems to be holding steady. And maybe that changes after OPEX this week. We'll see. Looking to other corners of the market, you're right, mortgage rates have gone up, yields are sticky, but I'd also know that credit spreads are widening a bit. And part of that could be that there's a lot of commotion in the private credit space. Now, I think of it as more contained than most people would think, but it's really hard to know. And so you have credit spreads widening a bit. So financial conditions, from my perspective, are a bit tighter than they were the last meeting. A lot of the tightness, I think, is still that the market is thinking that um, the Fed is going to be more hawkish because of oil prices. I don't think that's the right call. I don't think we'll get a strong move from the Fed either way, strong signal from the Fed either way about that. But I think as going forward, as the stock market declines, should it decline, and as um, maybe oil prices continue to rise, that you're going to have a change in the expected path of policy, and the market was going to focus more on Fed cuts and push against the tightening financial conditions.
Thank you, Joseph. Another one that's obviously been a hot topic for a hot second is gold and precious metals as a whole. Now, even though we had that, for lack of a better word, pardon my French, batshit crazy tumble from the highs, both in gold, silver, precious metals as a whole, I know a lot of people got completely fleeced by that whole scenario. But despite that, if you're looking at it year over year, it's stayed pretty elevated, even with the equity showing a resilience, which kind of goes counter to the logic that most people are used to when thinking of precious metals versus equities. And so I guess I'm wondering here, what does that say about the market's mood right now? Is it an inflation hedge, geopolitical hedge, maybe a sign that investors still just don't fully trust the broader macro setup? Martin, you actually reposted a tweet earlier that broke down some concepts about gold alongside the international dependence on oil. Do you care to take a stab at this one?
Yeah, absolutely. So gold does not do well in an inflationary environment where the Fed is going to be tightening and raising interest rates. And it does do very well in a falling dollar scenario and interest rates falling as well. So if you look at the previous examples, is what Joseph has highlighted in regards to similar oil disruptions. This isn't again, I keep having to reinforce this isn't a demand driven price response. This is solely a supply-driven response. And you can see that in the forward curve, and you can see that in oil stocks who are not that are not rallying with oil prices. Even the fertilizer companies that have been are not benefiting from the disruption in phosphates. And so the market is looking past that. But however, at the same time, you have right now a scenario where the market is selling off gold. It's off about 10%, and it's saying that maybe the Fed's going to be hold pat or neutral and not going to be cutting rates as much, and that's quite bearish for gold. So if the gold has been rallying on falling interest rates, money printing, for example, debasement, and that trade has taken a little bit of a pause. And as you had mentioned, it was quite strong. But if you take a look at 1990 Gulf War, 2007, immediately following the resolution of those supply events, which we will get some form of resolution this year, maybe a week, it could be 6 months. And then that will, and if it's longer, it's going to cause economic damage and a lot of economic damage. The equivalent gasoline price is equivalent to a 50 basis point rate hike based on the math that I've done. And so longer it goes on, the greater we're going to see an acceleration and rapidly more rate cuts, and that's going to be positive for gold. And so I think we're just in a holding pattern, and it's supportive for gold. And also, I think we're going to see governments liquidating U.S. Treasuries to pay for their deficits, and that's going to put continued pressure on the dollar and then be supportive for gold as well.
Thank you, Martin. And just to kind of pick on you a little bit, going back to something you said at the beginning of that answer, for those in the audience not really well versed, and those like me, proud holders of 2 liberal arts degrees with a very minimal focus on business, you mentioned supply side versus demand side issues with oil. Showing that currently we're in that supply side situation. Could you just really quick and explain it like I'm 5 years old, because I kind of am.
Okay.
What's the difference between those two environments?
So in the best example was when I was in the oil patch in from 2000 through to 2008. You had emerging markets in China rapidly growing, building out urban centers, urbanization of their country, and consuming a large amount of oil, and growing that demand growth, growing at an unprecedented pace. At the same time, you had supply constraints. U.S. shale was in its early stages, and globally there was higher decline rates that were facing capital constraints. And so you had a situation where you had a strong employment, you had wages going up, you had demand growing for oil, and supply unable to keep up, and that caused the price to move up to levels where we're seeing it currently. That's a much different scenario where you have demand growth actually slowing considerably. Still is growing, but albeit at a lower pace. China economically and emerging markets are nowhere near where they were back in the period I just described. And now you have 14 million barrels of oil being challenged to get to market because of the Strait of Hormuz. And eventually that will get resolved. But what's going to happen is it's going to create demand destruction because we don't have a strong employment situation. We don't have strong wage growth globally. And it could send countries into a recession. So as Joseph had mentioned earlier, if the longer that this goes on, we could see a whipsaw in that oil price fall back down, depending on if all that supply is able to get back on market and demand destruction has been hit. So I think that's really important to understand the two different situations, especially from the Fed perspective, because we're not going to see permanent inflation caused by these wage hikes because it's not demand driven. It's again supply side. Does that help?
Yeah, that was perfect. Thank you. I think a really good synopsis of the difference there. Thanks, Martin. So just a little bit more here. Kind of been some warnings this week, according to experts. Again, these are not my thoughts. I made the liberal arts comment earlier, and I stand by it. I am bringing to you thoughts from much greater minds than mine. But there have been warnings this week that in a more severe energy disruption scenario, equity downside could actually be much larger than the market's currently respecting. Now, Marco, do you think, just from an investment point of view, that investors and traders might be being a little too casual about that tail risk while they wait for the Fed, or are things kind of in line with what you'd expect?
I would like to to take a bit different side of the debate, because I think that actually the supply shock here is actually lower than what is usually floated in the media. Like Martin mentioned, 14 million barrels per day. I think it's more like 4 or 5 million, because there are mitigating factors, including uh, uh, some of that oil can be rerouted. Then you of course have this global SPR release. Then you have the Russian oil. Then you have potentially other things that could impact the supply. So actually, when you factor all that in, you are probably talking more like about 5 million than 15 million, for example. But at this point, I think oil prices are already like quite high for this supply shock. I mean, relative to what this supply shock actually is. Uh, that doesn't mean that prices cannot go up from here. For example, if we see more escalation in the Middle East, prices can go up. I mean, we can reach, I don't know, 100, 120, 150, whatever. But if we see something like that, it's likely going to be a temporary spike. It's probably not going to hold there for long. And for this reason, actually, I think that we are probably going to, either the market is going to get used to all this disruption in the Middle East. So, and I don't know, maybe the oil price settles here in the 90s or something, and we'll have this for another few months, or the war will end, and then of course if that happens, then prices can go down quite quite a lot. I mean, they climbed for like, I don't know, $60, and they are now in the 90s. So actually, this geopolitical premium is quite high. They've extended a lot, and I think that this 5 million, of course, it's significant, but maybe it's not as significant as the market is currently pricing, and as all of these headlines are actually telling us. So I think that this price in the of the $90 plus WTI, I think that it probably carries the risk of future escalations. So actually, if we don't see it, or if we see some kind of de-escalation, this will probably see the price going the other way. And of course, if that happens, then equities can go up. I think that seasonally, probably this won't happen. I don't know, for another few weeks. So probably this kind of trading, like I don't know, fears in the market about potential higher oil prices will probably persist for another few weeks. And then after that, especially if we see some de-escalation, and President Trump has been saying that the war will end soon. Of course, he has said that for I don't know how many times, but at one point it will be true. So we're just waiting for that. And the moment that happens, actually, I think that equities can recover quite quickly.
Thank you, Marco. Martin or Joseph, do you have anything to add or maybe even detract? You know I love a little bit of drama.
Well, okay, so what Marco's saying is correct. There's east-west pipeline the Saudis able to redirect. Also, Iran has been rumoredly to be allowed to continue to flow oil through the Strait of Hormuz. Then you got Russian oil as well too. So, but let's just say it's 5 to 8 million barrels off market. My experience being in the energy markets is that the marginal barrel sets the price, and the market's being proactive in regards to the spot price. But the future market is certainly reflecting in a return to more stable conditions. I would have to say that the equities, for example, long duration equities, have already been hit. Look at some of these stocks; they're off, 20 to 30% from their highs. Microsoft is off 30%, and others are off their highs. And even Nvidia is trading at, I think, 18 times PE multiple or something like that, if you believe the forward numbers. And so the market's been proactively pricing that in, as well as the forward market in oil. So the big question is that the correct state to be taking? I just worry. My bottom line is that gasoline prices have spiked dramatically across the U.S., and that is having an impact on the economy. And so segments of the market that are sensitive to the economy, and those stocks are going to get hit. Some of them already have been. And long duration equities that are not as sensitive to the broader economy and more sensitive to interest rates are probably representing a good buying opportunity. And that's why we continue to add positions to Microsoft, for example, and others, because eventually this will normalize, and these stocks are that much cheaper.
Man, the more you guys say, the more I'm glad I'm much more of an intraday scalper than an investor. Because just some of the stuff that you guys take into consideration for long term, it's like I'm very glad I'm only trading what's in front of me on like a 2 minute time frame. Way too much for someone like me to think about, I think. A little bit on inflation pressure, excuse me, rather, inflation trends and price pressures. So the picture on inflation going into this meeting, I would say, for lack of a better word, is kind of awkward because the CPI in February looked manageable at first, with the headline and core holding steady year over year. But that January core PCE was a lot firmer. And both of these reports largely predate the full impact of the latest energy shock we've been kind of harping on the whole panel so far. So the Fed's kind of looking at inflation data that says one thing, while the market is staring at, like Martin said, at gasoline and crude and seeing a potentially different story entirely in the days ahead. Now, how do you think the Fed, or rather even historically, how has the Fed handled that split between a backward-looking inflation data and what some would say a very obvious forward-looking energy problem? Joseph?
So I think the key here for them is to make sure that inflation expectations are anchored. And so from their perspective, they think that inflation expectations is a big determinant of actual inflation. So if they think that inflation expectations is stable, then this energy shock doesn't bother them because it's transitory inflation, right? Gasoline prices will go up, and then when the conflict ends, they'll go back down. So we'll have this transitory uh, period of higher prices. When we look at longer dated inflation expectations through TIPS, for example, TIPS break-evens, say 10-year TIPS break-evens, have been pretty range-bound for the past few years. So I think that does give them enough cover to say that longer dated inflation expectations are stable, and so they could look through this upcoming energy shock. Now, one thing I would also add is that there's a significant tail risk here, right tail risk for energy prices, not just because of the closure of the Strait of Hormuz, but what we're learning today is that there is destruction of the actual energy producing facilities. So let's say the gas fields, refineries, the oil fields, and so forth, they're being attacked now. And if that continues, you're not just looking at something that's temporary, but a structural decline in the productive capacity of oil and gas in that region that won't come back online for a few years. That's a whole different ballgame. And then you really, I think you can't just look at this as a straight of a Hormuz issue. You have to look at it as a more of a structural issue.
Thank you, Joseph. Martin or Marco, do you have anything to add to that before I keep us trucking?
Yeah, Israel struck, I mean, a major gas facility in Iran today. It's got to be pissing off the U.S. because it's the second large facility that they've hit. And
I think a lot more people than the U.S. are probably pissed about that.
yeah, exactly. And Iran responded that they're going to be targeting oil infrastructure assets elsewhere, and I wouldn't discount their ability to do so. So Joseph is bang on. If this becomes a tipping point into taking out infrastructure, and some of these prices, oil prices, remain anchored, I mean, the demand impact is, I mean, sustaining gasoline prices, if they stay where they're at for 6 months or longer, I mean, it's going to have a huge economic impact. I mean, you got to think about it. That's exactly why, I mean, high gasoline prices win or lose elections. And all previous administrations have tried their best to keep gasoline prices under wraps. And then that's going to create all kinds of consequences for the compensation of the Fed and going into US midterms. So that is, having the Fed recognize that, and maybe keeping some dry powder. And certainly, I think cutting into this kind of environment would be prudent, but I think they're going to stand pat. But there certainly is a lot more risk to the downside, and if that continues, then that's going to it's going to be hard to contain.
Fair enough. Thank you, Martin. So I guess at what point then does this whole scenario being an energy shock, at one point does the Fed look through and start becoming an inflation problem that they actually have to respond to? So like if headline inflation starts moving up again, for example, because of energy, while that core stays relatively better behaved, I guess a better question would be, how hard is that for Powell to communicate without either sounding complacent or sounding like he's overreacting?
Oh, well, first off, I want to follow up on Martin's point about
Yeah,
the
please.
political implications of this. So this is a really, really big deal, not just for the midterms, but also for 2028, because Trump is doing something that's very unpopular with his base, and it looks like high gas prices are going to be very unpopular as well. So if you take a step back and think about how this administration has been trying to do something very different, do tariffs, change in trade policy, make it America, and all that stuff, that stuff, that whole project could just disappear because you have change in political leadership, a big change in political leadership through the midterms. Say that there was a Democratic sweep, and say that the Republicans lose the presidency in 2028. So that's a kind of setting up the United States for a different trajectory. Maybe we have a different view of a view that's more, I guess, redistributive. So you got higher taxes. That's kind of what the leading edge of the Democratic states are doing, right? Like in Washington, they have a new income tax for people making above $1 million. In California, you have a wealth tax that's causing some billionaires to leave. So that could be, direction that the United States heads into because of this big, I guess, political change that's happening because of the unpopular conflict. And so that has implications on growth and all that significant as well. And if you think about the Middle East, a lot of the people there, they look at the US as a security provider, and they are huge financial centers that have been growing very well. Now, maybe that's not a viable business model for them. They used to have a lot of oil revenue in dollars. Some of that is reinvested into dollar assets, and some of that is spent buying US weaponry and all that. So that business model that they have, and that kind of capital flow in the global financial system, that's going to have to change as well. And I think, these are really, really big, profound changes that we're going to see very slowly on how this evolves. And like Mark mentioned, some of it is going to sometimes, some of them might have to liquidate some of their US style assets to defend their currency pegs. But also some of the people who put their money there thinking that it would be a financial center, maybe they have to move their money elsewhere as well. Now, back to your question about J Powell, I actually think that nobody knows how long shock is going to last. It could be structural and persistent, and so in that case, maybe it's not something that you should look through. But the thing is, as a Fed official, you just don't know. And if you just don't know, it becomes more of a judgment issue. And we're going to have a Fed that's changing. We're going to have a new Fed chair, Kevin Walsh, who's, again, probably had to make big promises to get that job. And, those promises involve lots of rate cuts. And so he has an out where he could just say, this is an energy shock, and we're going to cut into it. And we don't know what the future is, but we definitely have enough cover to do that. So I think because there's just so much ambiguity here, the composition of the FOMC matters a lot. And what we do know is that new Fed chair, maybe Chair Powell leaves, new Fed governor, and they're going to be more dovish. And so I still think they're going to look through it. Also, I have to hop off right now. Thanks so much for having me. I really appreciate it.
Always love having you here, Joseph. Thanks for that breakdown. Marco, do you have anything to add to either Joseph or Martin's point before we move along a little bit?
Well, I agree with both of them. Like higher oil prices are a big political problem. They are a big problem for all consumers, because if consumers need to pay more for gas, they are left with less disposable income to buy other things, and they actually need gas. Like you can substitute gas for something else. It's quite inelastic, and this means that actually with higher prices, it's more probable that at some point it will start to burden the consumption growth. Like maybe consumers are not going to spend as much as they used to if gasoline prices remain high. But as I said, I'm actually optimistic that we could see some kind of an end to this conflict over the next few weeks. Like President Trump has been saying that for a week or so, that the war will be over soon. We will see what soon actually means, but I think that's as soon as we see any headlines that suggest any de-escalation, oil prices could drop quite significantly, and this would have the opposite effect on gasoline prices and of course headline inflation. And what we said before, yes, if headline inflation only goes up a bit, and if core remains well behaved, maybe there's a path for the Fed even to cut if the labor market weakens from here. So I think it's probably better to focus on the labor market at this point than on inflation. Everyone expects higher headline inflation near term, maybe for a month or two or three or whatever, depending on how long the shock will last. But after that, of course, the headline inflation will come to some level, and at some point when the oil shock eases, actually the headline inflation will go down, and we will see by how much. But it's not impossible to see the opposite effect that is actually higher than the upward effect that we will have from now over the next few months. So this is why Joseph said that inflation is transitory. I mean, I don't like that word transitory, but the Fed actually likes that word. I'm more fond of the word temporary, because it actually is temporary. It will be temporary for a few months, but after that, I think that we'll be focusing on something else entirely. Maybe even if maybe we are going to debate whether the economy is as strong as we believe that it is currently, or that it maybe has gone in the other direction, and maybe recession odds go up. Who knows? But we'll see what happens. I think that inflation will be a non-issue in a few months.
I hope so, man. And I also hope that obviously the whole war will be over soon thing is like actual within a agreeable frame of reference soon. You know, I'd be remiss to say we might end up in another 2001 through 2020 situation, which I mean nobody wants that shit, right? I mean, like war's not good for anybody in my opinion, but to kind of take a little trip down the lane of the labor markets, we got about 11 minutes before we get some data. And hey, man, with Joseph gone, pressure's on, boys. I'm gonna need some stat top notch dot plot reading, man. But just labor first. February payrolls fell. I think it was by like 92,000, with unemployment rising to 4.4%, despite those initial claims that just, I think it was 213,000. But the labor market as a whole, you know, with as much clarity as we can glean from it, doesn't necessarily look healthy. But it doesn't look as, you know, layoff intensive breakdown style either, although we've got a lot of big companies kind of projecting a lot of layoffs in the months ahead. I think it was Volkswagen. They said something like 50,000 job cuts by 2030. Now 4-year timeline, so that maybe not as pressing as it might sound on the surface. But do you read this latest jobs data as kind of a real turn lower in labor, or is it just kind of like a noisy patch where, you know, weather strikes, employer caution are making the picture look worse than the real trend actually is? Martin, I'm gonna pick on you for this one, and I'm gonna need a banger because, buddy, I drank way too much water right before we went live, so I'll be back in like 30 seconds or so.
Okay. So the unemployment rate, you know, it's at 4.4, up from 3.9 and 4.1 a year ago. It's still orderly loosening, in my opinion, in conditions. Payroll growth is softened meaningfully, and non-farm payrolls in February. I mean, sure, some of it was temporary strike activity, but I certainly think it's reflecting broader slowing across hiring sensitive sectors. You look at labor force participation, it's down to 62%. Job openings are at the lowest level since 2020, and quit rates are declining. All signs of showing that worker bargaining power is fading. Um, and so I think it's going to trend lower. And then you have AI as well too, and the impact of AI. It's only just getting started on the labor force, and you put that all together, economically, it's telling you that we need to see rate cuts, and we need to see rate cuts sooner than later. Especially, again, I want to reinforce the point. At the beginning of the year, the expectation for a rate cut was, I think, 25% for now, and now it's zero. And the deteriorations have the labor market has deteriorated and gotten worse, and you have gasoline impact of equivalent to a 25 to 50 basis point rate hike. And that's important because if you take a look at, again, going back to the oil situation, 1970s, oil price spikes caused lasting inflation because wages rose automatically with prices, and that created a vicious cycle. There was cost of living adjustments. That doesn't exist today. So oil shocks, doesn't spiral into permanent inflation. So now you've got, summarize, you've got a weakening labor market, moderate wage growth is not keeping pace, and an economic impact. You know, Mark, I know what you're saying, but let's just say it sticks around for a while, a lot longer than what we expect. The Fed's going to have to react to that, and they're going to have to be cutting into it. That's just my 2 cents. Hopefully, that covered off your water break.
Yeah, man, perfect timing almost. I got to hear the tail end, and it actually right in time to give a little bit of a follow-up to you, if you don't mind. We on top of all the aforementioned, we keep hearing some version, some spin of a low hire, low fire environment. And sorry if you touched on that at the top of your answer while I was gone. But in that instance, how dangerous is a labor market where the real problem really isn't mass layoffs, but more so the quiet disappearance of new opportunities? Because I don't know if you saw, but the rates of recent college grads finding jobs is like at all-time lows in the last 25 years. We're seeing the same thing for people laid off. I think the average time between layoff and finding a new job has risen in the last year or two from like a month to 3 months before they're reemployed. What are we looking at with that?
It's an excellent point. Unemployment rates among young people and college grads being where it's at. I think in Canada it's like 14, it's like 14 or 17%. It's a big number.
Oh damn.
I'm not sure what it is in the US, but it's got to be similar. I worked with a fella when I'll tell a story here. A guy named Henry Droppy out of the US. Henry was an advisor to the Bush administration 1 and 2. And I was in my early 30s and he was in his 80s. And I was a young whippersnapper and he was, guy had been around the block and it was great. So I traveled all through the US and Europe with him. And he told me that demographics play a huge part in a country's political stability. And when you have young people and a large percentage of the young people who don't have work, it creates political and economic instability. And we're in an environment today where AI is disrupting that job growth. Maybe tariffs. I'm not sure how that's trickling through. And the traditional path to financial success has been going to university, graduating university, and getting out and getting a job. But at the same time, you have a housing market that is quite high, unaffordable, multiples of levels of income. So you're priced out of buying a home and you can't get a job. That's going to create a lot of instability. So I think that's a very important point that you bring up. We're not seeing huge layoffs, but we're also not seeing that growth, especially among the younger people. And I think that's going to have some consequences.
Thank you, Martin. Hopefully not, too tragic consequence. Because I'm not trying to take care of my niece. She hits college, you know what I'm saying? That's job. So kind of at more broadly speaking, I'll pick on you for this, Marco. We got about 4 minutes before I put you guys through the turmoil of explaining dot plots to me and the people listening today. But if we do see unemployment drifting higher without a real spike in reported claims, do you think that gives the Fed more room to ease later this year? Or does the inflation backdrop we've touched on a bit kind of take that flexibility away from the Fed, Marco?
I think they will certainly react to any increase in the unemployment rate. And speaking of which, actually the unemployment rate has increased quite a lot, but all of these increases have been masked by the lower participation rate. If we plug in, like if the participation rate was left at the same rate where it was in April 2025, today the unemployment rate would be 5.4%. Like this is like huge. It actually went up 1.2 percentage points in 10 months. This is something that most people don't see because it's masked in a lot of numbers. But actually, this is what has happened with the labor market in the meantime. And people think that it's only like, okay, it's jobs are not growing as fast as they used to, but actually the labor market is showing negative job growth month after month. If we include all the future revisions that are going to take place, and they are going to take place because we see the data and we see what the BLS has been doing for the past few years. And if they continue to do the same thing, we could actually be looking at like 8 negative months in the last 10 months. This is like huge. It's more than people are than people think at this point, and this cannot be explained by the AI or by the government shutdown or by the geopolitical stuff or whatever. It's actually quite it's actually the real weakening in the labor market. And if this continues, the Fed will need to react. And of course, if this 1.2 percentage point increase in the unemployment rate actually becomes visible in the actual unemployment rate, regardless of the participation rate, then the Fed will most certainly cut, and by a lot. The longer they wait, I think the more they will need to cut later on.
Martin, would you agree with that?
Oh, sorry. Yeah, no, he brings up some really good points. It's always good to see to take a different look at the data and what it's telling you. And I mean, the big thing is time is going to tell you as to the AI impact, and that's pretty material development, and it's going to create major changes in the shape and context of the labor market.
Yeah, I'm really curious because just kind of recently, I know we're getting the data drop here in just a second, but quite recently there was a report that CEOs of even big companies have said that despite utilization, productivity hasn't really increased. And it hasn't had them moving their goalposts on hiring metrics. But I do wonder ultimately the longer term. I don't want to say consequences, but the longer term landscape of AI integration into the workplace.
Yeah, that's the $1 million question. And I can only speak to my own use of it. And I remember my sell side days, the use of AI integrated into my Excel, into my workflow. It's an AI agent, is considerable. It's equivalent to me having 3 or 4 analysts working for me. And those analysts would be making lots of money. And so those are less people I'm hiring from university, unfortunately.
Yeah, really crazy times, I think. Now, surprising no one so far, the Fed has held rates, no cut, no increase, hanging out. I'm going to give Marco and Martin a hot second here to kind of dissect the dot plots and some of the notes therein. We've got about half an hour before Jerome Powell will take the podium for questions, etc. But for now, let's just mull things over a little bit. Feel free to chime in if you see anything interesting. I know at the top of the show, Joseph mentioned he expected a couple of dissents at least. So I'm curious to see what we've got. There's also one thing I want to touch on while we kind of look things through and take a peek at the dot plots here is, do you think there's any outstanding pressure kind of hanging over from the general like political pushback aspect between Jerome Powell and the administration? I know his term ends in May, I think it is, and he's running out of FOMC meetings before he's done. Hasn't really spoken on whether or not he's going to stick around after the fact. Do we foresee any kind of pressures on Jerome Powell as he nears the end of his term here? Either of you feel free to chime in on that, or if you've seen anything in the drop so far worth talking on.
Okay, so um, actually, not a lot has changed. We only have one dissent from Myron. Waller did not dissent. This was perhaps a bit surprising. I think that maybe Joseph expected Waller to dissent because he dissented in January.
Yeah, that was Waller last time too, right?
Yeah, yeah. But this time he did not dissent. So actually, this raises some questions, maybe. Regarding the rate path, the SEP actually is completely unchanged from the December. So they expect one cut in 2026, one cut in 2027, and then no cuts in 2028 and later. And that's what I see for now.
Looks like they're signaling a little bit of a higher inflation profile beyond the energy sector sensitive components. And so longer term inflation expectations are still anchored at 2%, but they still see pressures that will ultimately fade rather than becoming entrenched. So I guess there's nothing really there. Growth projections were revised slightly higher across the forecast region. So real GDP growth a little bit higher. And your Marco's right about the descent below the surface there. And mostly in regards to inflation rate projections. So it's kind of what I'm seeing here. Looks like it's less reactive, but not complacent. I mean, like it's cautiously optimistic. Is I hate that word, but that's what describes it.
And funny enough, I know on these panels we don't really talk about intraday reaction, but like I said earlier in the show, I'm an intraday scalper. That's what I do on our trading show on Monday and Wednesday. It's just how my can't look too far in the future brain works. And honestly, right now, looking at the Nasdaq and the S&P, this is probably one of the more muted instant reactions that I've seen since I started working here, man. Like this is nothing's happening in equities. They're not reacting to this at all. So I guess they kind of maybe they accurately priced in what was expected. What do you think, Mark?
Long bonds aren't moving. Gold is still selling off. S&P's, hasn't like there's no changes. You're right.
No surprise at all. Interesting to see. Usually, I have a buddy of mine who's a scalper as well, and he usually goes hog wild on FOMC. Nothing. This is so muted. So I guess I want to touch a little bit on growth here. We've got 23 minutes before I flip us over to the audio of Jerome Powell's questionnaire and presser. Growth, which we've harped on a little bit throughout the panel so far, it kind of already started losing its altitude before all of this war stuff happened, before the latest oil shock landed. The fourth quarter GDP was revised down to 0.7%, with an accompanying weakening in consumer sentiment as those energy prices moved higher. So even before the full economic effect of this current shot has worked its way into the system, the economy was already kind of coming into this meeting on shakier footing than I think a lot of people expected. So looking at it now, after this FOMC, how sustainable do we think the growth story from here is if higher energy prices start acting like a tax on consumption just as labor begins to soften? Marco, you want to take a stab at that?
Yeah, this will actually depend on how long the oil prices are going to stay elevated. Because if these gasoline prices go above $4, $5 a gallon, and they remain there, they are probably going to eat into the disposable income of consumers, and the growth will probably slow down as we go forward. And you mentioned the fourth quarter growth. Actually, the fourth quarter was impacted by the government shutdown. there was this big impact from a big negative impact from the government spending. I think that it subtracted one percentage point of growth, and actually without this government shutdown effect, the growth would probably be somewhere in the twos, maybe 2%, 2.2, something like that. That's still a solid growth. It's not like growth falling off a cliff or anything like that, but it's not as strong as it was in the third quarter, when it was 4.4%, and the Atlanta Fed was for the most part of the fourth quarter, the Atlanta Fed was actually at 5% plus. So people were expecting higher growth in the fourth quarter, but this was a negative surprise for many, me included. I thought that the government shutdown effect would be less than it was in the fourth quarter, but this means that probably the first quarter could have some of this negative effect brought back, and it will turn the other way, meaning the growth could be a bit higher than it usually is in the first quarter, and then in the second quarter probably, as many know, there will be the tax refunds that could, in theory, increase consumption in the second quarter. So we will see. This could be something like a short-term bump, and then the question is what will happen in the third quarter and in the fourth quarter, especially as we are getting closer to the midterms, and this will probably determine how the economy will look like for the remainder of this year, and what we'll have the next year as well.
I think Marco nailed it, and I think the Fed is factoring exactly what he said in their SAP. Sorry. If you look at they're treating what happened in that quarter as more like noise and not carried forward. Really interesting is that if you look at the oil shock, I think they're looking at this. My interpretation of reading through is that it's not really a demand destroyer yet, and I think they're underestimating the impact. That's just my opinion. I've seen it before, being an active participant in trading energy stocks and actually trading commodities, the energy commodities themselves. You can't underestimate the impact on demand. Otherwise, you're going to lose a lot of money. And a Fed is taking a neutral path towards that. But the numbers will show up, maybe, as Marco mentioned, in Q3, and it will have an impact. And hopefully he's right that this thing gets resolved sooner than later. But talking with all my OPEC friends and Middle East contacts, it seems to be getting worse, not better, unfortunately. And the Fed may be taking too maybe hawkish of a stance here, and the market's pricing that in, and it doesn't mean they're going to be right, and so just be careful.
Fair enough. And just to kind of harp on this a little bit further, when we have a scenario with backward-looking inflation data looking a little manageable, but that forward-looking growth data keeps getting weaker and, revised down, as it were. I guess now, factoring in the fact that, even recessionary talks are coming back to the forefront a little bit, and there was a mention earlier on the panel about we might already be chilling in a global recession. I guess, which side of that trade-off do you think the Fed is actually more worried about right now, moving into the presser for this FOMC decision? Martin, what are your thoughts there?
I don't think they're worried about it yet. Not from what I'm reading. I don't see them being worried. It's more of, it's steady as she goes. There's nothing in here that gets me, like they're worried about the economic pullback, the impact on continuation of labor softening, inflation expectations. So it's kind of like a blah piece that they put out. That's just my opinion, and I think they're wrong. Like there's I don't know. Again, I have a lot of money in the market and managing money. If they're not proactive here, and they're going to have to be proactive at the next meeting. I mean, there's just a lot of risks out there that I think they're underestimating.
Fair enough. What do you think, Mark? Do you agree with that? Do you think that they got to be a little bit more proactive moving forward into the April meeting as well?
Well, I don't know. I think that they probably don't know what will happen next, and they are probably not going to rely much on one view or the other. They're just going to try and assess the situation and see what is actually happening, because they're in their mind there are probably a few possible scenarios which could be in the opposite directions. For example, if oil prices remain higher, some of them worry that core inflation could also go up, and that this could potentially become a problem over the longer run. That is probably a bit stretched, but nevertheless, some of the Fed officials still think that is possible. On the other hand, they don't know what is going on in the labor market. Whether the labor market is like, okay, maybe we are going to see something like 10, 20k payrolls per month, or we are going to see something like, okay, negative payrolls, like maybe they're minus 20, minus 30, minus 50, or whatever. Maybe the unemployment rate starts going up. If they see any of that, they are probably going to cut. Like if I think that if March employment report is anywhere near as weak as the February employment report was, they are probably going to put that cut back on the table, and they are going to discuss it probably, because they're still quite sensitive to the labor market, and probably the labor market is going to tell them more about what they should do than inflation itself, because inflation is like, okay, they cannot really make too much sense of it, because they think it's still affected by the tariffs, it's affected by the geopolitical shock now, and so on, and there are a lot of this temporary stuff that is actually affecting inflation data, but the labor market could be more of a signal for them, and I think it's probably worth following what is happening there, because the labor market is probably going to tell us what they will do going forward.
Thank you, Marco. So one last thing before I punt us over to doing a little topic tipple about the bond markets. Assuming we have time, we got about 12 minutes before J. Powell takes that presser podium. But there's kind of I hate to keep harping on hypotheticals, but if we're being honest, we're kind of floating in a very hypothetical environment. And so I just like to kind of touch all bases on what ifs, just because there are so many what ifs. So just focusing on some of the more forefront what ifs, there is a version of this where the economy as a whole does avoid a formal recession, but it still drifts into kind of like the Bud Light version of stagflation. I guess first, what even is stagflation? Because we hear that term tossed out a bunch, and we have over the last, like 5 years at this point, during the entire COVID pandemic shutdown, et cetera. Stagflation is getting brought up all over the place, but a little less as we came into 2026. Is that, in addition to what it is for the listeners, is that now the more realistic risk, rather than the clean soft landing story that markets wanted to believe in earlier this year, dating back into 2025? Martin, what do you think?
Oh, yeah, I think that's a real risk. I think you're going to see the commodity prices due to supply constraints. I wrote a piece on it this week in the Financial Post. You can pull it up there. But I talk about how we're in this AI race. I have a lot of good friends overseas that are political advisors to the EU, for example, and they're right close to it as it comes. We're in a global AI race here, and an energy security race. If you take a look at the U.S. positioning around, I'm going somewhere with this. Take a look at the U.S. positioning around South America, Venezuela in particular. I've also been there and looked at their oil fields. And you look at Greenland, you look at the Suez Canal. Now you look at the Middle East. It's securing critical minerals and energy to supply this AI race, and that's going to drive up the demand for commodities and secured commodities. Normally, that wouldn't have happened on a consumer level basis, and so that's more again of a supply side situation. You have the U.S. consumer or global consumer that are struggling with affordability. Affordability is a major issue. And I've traveled in the U.S. more recently. In Canada, it's a major issue. Just my own experience being down in Palm Desert, a dinner for two out, just my wife with no alcohol is $100 US. And you do the exchange rate, it's ridiculous. So and talking with people, Uber drivers and such, affordability is a major issue. Now you have this big spike in gasoline. Again, I don't want to belabor the point. So you have a weaker consumer, assuming the stock market doesn't correct and it stays where it's at. But if it does, that's going to also impact the consumer. So that's setting up to give your explanation of what stagflation is. You have rising commodity prices and a weakening economy, and that makes it very difficult for the Fed, right? It makes it difficult for central bankers to manage in that kind of environment, and your investments have to reflect that. So that's why we own commodities in our portfolios as a hedge. We own gold in our portfolios. We own producers of those critical minerals, and it's important to have that in your portfolio. Bonds in this environment are going to do terrible, and you're going to see a range bound. I mean, if you had bonds in your portfolio the last couple of years, it's been terrible. And we have no weight, zero weight weighting to our bonds, even for our conservative investors. And that's been very beneficial to us. And I think that's the new paradigm going forward.
On the note of that paradigm, I know I've brought it up before. I've brought it up with Jem when he's here, when Joseph's here. On that note, do you agree that the traditional 60-40 style of investment might actually be dead at this point? Is that the kind
Oh,
of
it's dead.
environment
It's
we're in?
long dead. I mean, it's been dead for a while. I mean, bury it. If you're and you have to adapt as a portfolio manager. My book's going to get published in December. Harriman House. It's called Investing Through the Storm. I talk
Oh
about
hell
that.
yeah! I got more books to harp on for the show. Let's go.
Yeah, and I got a nice picture of a sailboat and a storm. If you take a look at our biases and the average money manager, we have to adapt to the environment that we're in. 60-40, adding in government bonds in a stagflationary environment is going to be terrible. And you look at the debasement impact of money printing. I mean, we're at 74 to 80 cents a dollar from 2019, and how are bonds protected you against that? So you're not doing your clients any favor by saying bonds are the safe hedge. And as you mentioned, 2022, they did nothing to protect your portfolio. And so yeah, we could see rate cuts and bonds not respond to those rate cuts. I mean, we're in a whole new world right now.
Yeah, I've noticed that the bond market itself, like the yields have kind of, during all these whiplashes we're seeing in oil and I guess to a much lesser degree in equities, kind of elevated. The front end is repriced, and the long end is like kind of stayed there, if I understand correctly. Like with growth data saucing, it's just kind of hanging out. And I guess I wonder just on that, since we have a little bit of time here before the presser for bonds, uh, what is that even really telling us right now? Is this the type of rates behavior you'd usually expect if we're, seeing weak growth alone as the dominant factor? Marco, you want to tickle that before I pick on Martin some more?
Yeah. Well, actually, growth has been better than some of the expectations. If you look at it from, I don't know, 2022, when everyone was calling for a recession, and then it didn't, it wasn't, it just wasn't there in 2022 or 2023, and then we moved to later years, and the growth actually continued to surprise everyone. For example, the 4.4% in the third quarter. This is something outstanding for for the economy as large as the U.S. And then you have this productivity growth that is usually tied to the AI. Whether that's sustainable or not, we'll actually need to wait for the data, because this data can be revised a lot in both directions, and it's not like we all think, okay, the growth is this or that, and then after, I don't know, 8 quarters, we realize that it wasn't what we thought it was, but it was something else entirely. For example, in 2022, there was this. Everyone was focused on the recession, and 2 negative quarters in the first half of 2022, and then sometime in 2024, the BEA actually revised up the second quarter growth from negative to positive. And as it turned out, okay, there weren't two consecutive negative quarters after all. So this is like, okay, we think we know what is going on, but actually it will take a lot of time for us to see what is actually going on. And the bond market is responding to the data they see at any given time, and it's not like including the forward view. Okay, what is going to happen with growth in the future? Because everyone just looking, okay, 4.4% in Q3, then 0.7% in Q4. This is like, okay, maybe this was a government shutdown effect. Maybe some of that effect comes back in Q1, but then in Q2 we will again probably have a better growth because of the tax refunds. And then when we factor all of that in, you get this long-term yields. The 10-year is trading, has been trading in the range between 4 and 4.2, 4.25 for, like, I don't know, several months now. And it will probably not break out of that range until we either see something like, okay, the growth is picking up much more than we are currently anticipating, or the growth is slowing down much faster than we are currently anticipating. It will break either on the upside or the downside. I think it will break on the downside, but exactly when will that happen? It's probably a bit trickier to determine, because it will depend on a lot of stuff, including the labor market, and whether it will start showing those weaker numbers that I talked about earlier.
Fair enough. Thank you, Marco. We've got a minute and some change before Jerome takes the podium. Let's see if he's rocking that purple tie today or not. Before we go, starting with Martin, then Marco, where can people learn more from you, find the stuff you're working on? Because again, every time I host these panels, it's invaluable for me. I learn so much, and like I say every time, man, I'm ignorant about all this macro stuff. I look at the green and red candles on 5 minutes at a time, man. So these make a big difference to me in kind of keeping a larger bird's eye view. So Martin, where can people find more about what you work on and what you're doing?
Yeah, you can find me on X here at mpeltiercio. You can also go to my website at www.tribestwealth.com. And then we also put out a free Substack every month, so you can sign up there, talk a lot about the macro issues. I really try and focus on actionable investment ideas. And I eat my own cooking because we're managing significant portfolios alongside these big macro themes that I'm talking about. So everything has an actionable trade around it.
Fair enough, Martin. Thank you. And as always, man, thank you for coming and keeping things fun and interesting.
Thanks for having me.
Marco, where can people find more about you, about Arcamino Research, and what you're working on?
Yeah, you can find me here on X on mbiegovic handle. You can find my work on arcominaresearch.com and on Arcamina Research Substack. This Substack has some estimates, CPI estimates and PCE estimates that go out each month. And my CPI estimates have been better than Wall Street for about 70% of the time. I've been doing them since early 2023. So actually, this has been going on for a while. So if anyone is interested in that kind of stuff, you can find it there.
Beautiful. And thanks as always for coming, Marco. Love having you and your takes here every time.
You
Check
too.
these
Thank
guys
you.
out, everybody. You're missing out on a lot of free spoon-fed information on how a lot of this stuff works. Definitely check them out. Give me just a few seconds here to get the audio set up, and I'll kick us over to Jerome Powell's presser and subsequent questionnaire. Thanks, as always, for coming, everybody. If you came in late, don't worry about it. This will be released tomorrow morning with the full discussion on the Unusual Whales, Apple, and Spotify podcast. All right, I'm going to flip this over to J-Pal, folks. Have a great rest of your afternoon.
Though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last
We're just
September
fixing
through
the audio
December,
here. Sorry for
we
the
lowered our policy rate
mild
0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans.
We're just trying to get
We at
Powell
the Fed
up.
will
Apologies
continue
for the
to
delay.
do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, and we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement, and also what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past
Yeah.
about.
So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Nick.
Nick Timoros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So. And so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the the higher borderline of restrictive versus not restrictive. And we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January, revised down. February, posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So. We look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So. We looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing, as our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to move they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SEP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year? No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to the price, into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to
so
move
I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it. But you know, we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question, because it's really is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.